Cool. Right, excellent. So morning everybody and welcome to my update presentation about Brexit. So and I know you heard Jason and I talking just there, but just to let you know a bit how this is going to work. I did a presentation for Darlington Business Club last October about Brexit and what it was going to mean for VAT. But obviously a lot of what we were saying then was conjecture and thinking this might happen, this is what we think will happen based on the rules, because you'll remember we didn't actually get the trade agreement with the EU until Christmas Eve. And then in that week between Christmas Eve and New Year, 60 pieces of the VAT guidance were updated. So there were massive changes. Some of them were what we expected, some of them weren't. So what I thought it would be useful to do now is an update on what actually has happened since then. So what we know, there's still some things we don't know, even more than 9 months into it. But I thought I've now got 9 months worth of answering questions for people and researching queries and things. So I can give you an idea of the sort of things that are affecting businesses, the sort of things that are coming up. And then I'm hoping we can all have a discussion at the end, or in the middle. Feel free to jump in the middle if you want. We can have a discussion at the end about how it's affected you and any particular issues you've been struggling with. We can try and get to the bottom of some things. There just isn't an answer yet. We've just got to muddle through as best we can, unfortunately. But I shall attempt to share my screen now. Well, I seem to have two lots of slides on my screen share thing. I don't know how I've managed that, but let's see. So from the slideshow from the beginning, can everybody see those slides? Does that look, you can see them on your screen? Excellent. So as a starter, put together a little agenda. So we'll talk about where we are now with Brexit, what's happening, import and export declarations, because obviously they're completely new for transactions with the EU. People who've traded outside the EU have been used to them, but we're not used to them for the EU. Sorry about that. Buying goods from the EU and dealing with import VAT, because that does seem to be a key question that's come up a lot lately. Selling goods to EU businesses, importing goods that are low value into the UK, and selling low value goods to the EU is a massive one, and one where there's a lot of answers, but none of them are particularly appealing. So we'll go through those. And then, as I say, a discussion at the end. So I've not got a humongous number of slides. We want this to be interactive, want to have a chat, but we will turn off the recording at the end so that people can feel more comfortable opening up about things if needs be. So where we are now, we are no longer a member of the EU. So the new rules, the bulk of them, applied from the 1st of January 2021. So we're well into the new system and how it applies from a VAT point of view. There were additional changes for low value sales to consumers in the EU from the 1st of July, which we'll talk about later. I've got some more slides on that later on. There is now a distinction between GB and Northern Ireland. So previously, the UK meant all of us, that the VAT treatment for all of us was the same. But because of the Northern Ireland Protocol, what we needed to do, because of the Good Friday Agreement, was to avoid a hard border in between Northern Ireland and Southern Ireland. And the only way to avoid that is to put a border here instead, between mainland UK and Northern Ireland. Now, there are some, I'll just admit Sam, he's appeared in the waiting room, hopefully he's coming. There are some videos circulating online of Boris Johnson saying, if any Northern Irish trader is asked to fill in an import or export declaration, tell them to come to me and I will tell them to put it in the bin. He obviously didn't read very carefully the agreement that his party came up with and signed, because that is exactly what Northern Irish traders need to do. So for trade with the EU, Northern Ireland is at an advantage over the rest of the UK, because they actually are still part of the single market, still part of the customs union. Trade between Northern Ireland and the EU is much the same as it was before Brexit, but for GB, mainland UK, it's very, very different. And that means when we're selling goods from mainland UK to Northern Ireland, there are customs formalities, despite what Mr. Johnson said about putting the paperwork in the bin. We have got import and export documentation which needs to be completed, which we'll come on to on the next slide. There are some deferrals at the moment, but they're going to be ending shortly. So by and large, we are a third country, separate from the EU, and different rules apply. No, I've done something, so, oh, there we go. I was thinking it doesn't want to move on to the next page. There we go. Right, so hopefully the slide you can see now says import and export declarations at the top of it. So, as I said previously, any companies which were trading in goods with countries outside the EU will have been familiar with completing import and export declarations, and they are exactly the same paperwork. The difference is it now applies to all goods coming into the UK from anywhere outside the UK, and any goods leaving the UK wherever they're going, whether it's EU or non-EU. The important thing is to establish who is responsible for that declaration. And I've seen a few cases where the seller didn't do the declaration because they thought the buyer was doing it, and the buyer didn't do the declaration because they thought the seller was doing it. So I think it's very, very important to open a discourse between the buyer and seller and work out who is responsible for what at which point. A business will need to think about whether to deal with those declarations in-house or whether to pay an external expert to do it. And I think on the whole, that depends how many imports and exports you're going to be dealing with, because you need to have the correct software in place to be able to submit it. And it's an 8-page document with lots and lots of boxes that need to be filled in, and not a very helpful set of guidance explaining what goes in each box. So unless it's something you're going to be doing on a regular basis, it is probably better to pay somebody to make the declarations for you. If you're doing it all the time, yes, you probably do want someone in-house. There was funding available for such training, which I think has closed now. But it's definitely worth talking to your local authority to see if there are any grants. There might be other pots of funding they can find for you for training. In some cases, the declaration can be delayed up to 175 days. So originally that was only going to last for 6 months, but as I'm sure you've seen on the news, everything's been extended and extended and extended. So you don't have to make an immediate declaration. The problem is, because you don't have to make an immediate declaration, some people are bringing goods in, declaration doesn't have to be made at that point in time, and then the goods are brought in and everything's forgotten about and no declaration is ever made. So you just need to be careful that that doesn't happen. And I've put there that HMRC are following up on businesses, and I've seen a letter this week from HMRC to a taxpayer, basically along the lines of, we know that you have imported goods in the past. We have not seen any import declarations that you have made since Brexit. We're very surprised at this. Please make sure you do them if you should be. So for some businesses, that might be right. They might have brought things in before, but only as a one-off, or they might have brought things before but changed their business model and no longer do it. But you will be chased up by HMRC if you're not making import declarations. So it is very important to get on top of that. And if the declarations haven't been done, make sure they are. You need to know the commodity code and the country of origin for the goods. So again, this is something which you always would have needed for bringing goods in from outside the EU, but now you need for the EU. So every single product has its own commodity code, and that commodity code gives us the information as to what duty is chargeable when those goods are brought into the UK, or vice versa, when they go into other countries. So it's vital that that code is right, which is another reason why it's useful to have an expert do the declarations for you, because they'll have more knowledge of establishing what the correct commodity code is. And the country of origin, again, this is something you may well have heard on the news. We do have a trade and cooperation agreement with the EU, and certain goods underneath that can move between the UK and the EU free of duty, but only if those goods originated in the UK or the EU. If they originated somewhere else, somewhere outside the EU, then there very well may be duty to pay. So again, country of origin is something very important that needs to be looked at, which is something you probably never had to think about before. It's something that's causing people quite a lot of difficulty, because it's easy if I grow a crop of wheat and harvest it in County Durham. I know full well that that wheat originated in the UK. There's no question about it. But what if I'm making a radio and the frame of it, the package, comes from China, the wires have come from Germany, the solder has come from Taiwan, the aerial has come from America, and it's lots of different parts put together? Then there's lots of different rules about the percentage of value added in different countries. So it's a whole topic unto itself. So it is very, very important, and an extra step of work that businesses haven't had to think about before. And I've put a link there to the UK trade tariff. So if you are importing goods, that's where you need to look to find out what duty is payable on those goods. So, and if there's a quota, if there's a limit to how much of those goods you can bring into the UK. You need the commodity code, and you need to know the country of origin. And if you put that information into that trade tariff at that link, that will tell you what tax is due when the goods come into the UK. So I shall just have a sip of my tea before it goes cold. So this slide here, apart from the red bit, is just reproduced completely from the presentation I did back in October 2020, because this information on buying goods from the EU actually hasn't changed. This, exactly what we thought would happen, has happened. So that's good. At least businesses were able to be prepared there. So you need to make a customs declaration if you're buying goods from the EU. And again, as I mentioned previously, you can appoint an agent to do that for you rather than doing it yourself. You must have a GB ERE number, and I would have thought most people have got one by now, but there is a link there if you do need to set one up. It's completely free. You just click on the link, enter some information about your business, and you'll be issued with an ERE number. Any imports over £135 will be subject to import VAT and duty. So we'll cover that in a bit more detail on the next slide, the import VAT. And again, I've mentioned there about the customs declarations could be deferred, and that's now been extended. I believe to the 30th of June next year, you can make a deferred declaration. And again, there's a link there to the UK trade tariffs and a copy of the letter that was sent to VAT registered traders, just letting them know what was happening. So none of that's changed since I did this a year ago. The bit where I have been getting a lot of questions from people, so I thought it would be good to dig into it in a bit more detail, is how to account for that import VAT. So import VAT is due the moment the goods enter the UK, subject to the separate rules for Northern Ireland that I mentioned earlier. So as soon as those goods reach the UK border, they're subject to import VAT. The rate of VAT that applies is the rate of VAT that would apply if you'd bought them in the UK. So they may well be zero rated or exempt, in which case it's not a massive issue, but most things obviously will be subject to VAT at 20%. So say you're bringing in a consignment of men's slippers. I don't know why men's slippers came into my head as an example, but they would be subject to import VAT at 20% when they get to the border. Now, quite often, what a business will do is pay that via a freight agent. So the freight agent will deal with bringing the goods in. They'll charge you for carrying the goods. They will make the import declaration to HMRC, but using your EORI number as the importer. And they will send you an invoice for the transport costs, for the duty, for the VAT, and for their fee for doing it all for you. You can use a duty deferment account, which basically the VAT's still due at the border, but it's collected once a month by direct debit by HMRC rather than being paid on an invoice basis. But the principles are still the same. So you pay the VAT either direct to HMRC or to the freight agent, and then you receive a form C79 from HMRC each month, and that allows you to recover the import VAT on your next VAT return, subject to the normal rules. So you pay the VAT either to HMRC or the freight agent, and you recover the VAT on your next VAT return, assuming you're not partially exempt. So there is no actual VAT cost any more than there would have been if you'd bought the goods in the UK, but there is a cash flow implication there because you're paying the VAT up front and then you're recovering it on your next return, which obviously could be 3 months later, depending on the timing. Which is why we have postponed accounting for import VAT. So if you choose to use postponed accounting, the import VAT is no longer payable at the border. You still need to do the import declaration, still need to include your EORI number. But instead of paying the VAT at the border, you deal with it on your next VAT return by including it in box 1, and you then recover it in box 4, subject to the normal partial exemption rules, etc. So the end result is exactly the same. You're paying the VAT, you're recovering the VAT, but you're doing it all on the same VAT return. So there's no cash flow cost as there was with the standard VAT accounting, which if you're bringing in something worth £1,000 might not be a massive issue. But if you're bringing in £1 million worth of goods with £200,000 worth of VAT on, there's quite a big difference between having to pay that £200,000 up front and recover it on your next VAT return, rather than not having to pay it at all and just having a paper exercise on the VAT return. So if you use postponed accounting, instead of that C79 statement that I mentioned on the last slide, you actually download a postponed VAT statement from HMRC each month, which you do via your government gateway account. And those statements are only available for 6 months. So you do need to make sure you log in regularly and download them. So the issues that I've seen so far with these, the main one is that people have not been making a conscious decision about whether to use the standard VAT accounting or the postponed import VAT accounting. The freight agent has merrily carried on their way and filled in the import declaration and not actually asked the buyer whether they have a preference, because most buyers are going to say they want to use postponed accounting. Why would you choose to pay the VAT upfront if you didn't need to? But a lot of freight companies have just automatically left it as standard accounting if they haven't specifically been told. They've not been proactive and gone to the customer and said, which would you like to use? So if you do want to use postponed accounting, you've got to just let whoever is completing the import declaration know. And when they fill in, so the C88 that I've referred to on that slide, that's your import declaration that you fill in when the goods come into the UK. And all they need to do is enter a G in box 47E. So there's no need to apply, it doesn't need to be approved, you don't need to have permission from HMRC, you just enter a G in that box when you submit the import declaration. So one problem is that the freight companies haven't asked anybody what they want to use. So most people have ended up on, oops, sorry. That was me knocking my bottle of water over, sorry. Luckily the lid was on. So people have just been paying VAT up front when they didn't need to. Another major issue is that there's been a complete mixture. So some people have, within a month, bring in 10 things. Some of them will have been included as postponed import VAT accounting, and some of them will have been included as standard import VAT accounting, which is not a problem. You can make the decision on it, every single individual import, but it makes it a bit harder for record keeping if you're having to think about every import, how you post it to your accounting software, which type is this, what should I be doing with it? It makes that process much slower. Another issue I've seen with this is that there have been errors on the statements provided by HMRC. So the January and February statements in particular for postponed import VAT accounting had duplicated entries on. So imports were included in both months. I've seen some where people have definitely brought the goods into the country and nothing is showing on HMRC's statement. I've seen some the other way around, where there's things on HMRC's statement and the clients looked at it and said, but I haven't brought anything in. What are they talking about? Some of these are simple to resolve. It's because the EORI number on the import declaration has been entered incorrectly, maybe one figure wrong, so it's shown up on the wrong taxpayer's account. Some of them we just haven't got to the bottom of and haven't worked out why the statement is different. So I'd strongly recommend, if you are importing goods, whichever way you're doing it, whether you're doing it under standard import accounting and receiving a C79, or postponed import VAT accounting and you're getting these statements, double check, look at the things you bought from overseas and think about how much VAT you expect there to be. It might not be exactly the same because you're going to have exchange differences and things like that. But in general, you should be able to match the invoices where you've imported goods times 20% should match the figures on the C79 and the figures on the postponed import VAT statement together. If they don't, HMRC has said, oh, I'll just have a go. Or well, not exactly that, but basically, as long as you make a reasonable attempt at getting the figures right, if you've got 5 invoices and there's only 4 on your postponed VAT accounting statement, HMRC are not going to object to you using the 5 if you believe that is the correct figure. If there's something on your postponed import VAT statement and you are absolutely certain it's nothing to do with you, you didn't bring anything in on that date, or you've bought nothing of that value, they're not going to object to you missing that off the VAT return. In most cases, if a business, the importer, can fully recover any VAT they're charged, it's not going to make a bit of difference anyway, because it goes in on box 1, comes out on box 4, the end result is nil. And any VAT penalties are based on lost VAT, and there's no lost VAT because it's all recoverable. It's only going to be an issue to businesses who are partially exempt and can't recover all of their VAT, because then there might be a VAT cost there. But always do a reconciliation so that if you ever did get a VAT visit, you can show where you've come up with the figure that you've included on the VAT returns. I think that's the key point there. I should just have a sip of water while you absorb that before we move on to the next bit. So we've talked about bringing goods into the UK, not low value goods, because we'll cover those separately because they're a whole entity unto themselves. But for goods valued over 150 euros, we're talking about what to do when you are selling those to EU businesses. And I think my key thing here that seems to be coming up again and again is agreeing the Incoterms with the buyer. You need to know at what point in the sales transaction does ownership pass from you as the seller in the UK to a buyer in the EU, for example. Because if it is an ex-works sale, you're selling those goods to that buyer in the UK, and it may well be that UK VAT is chargeable, depending on the circumstances. You may be able to zero rate it, but that's a bit outside the scope of what we're doing here. If you are doing DDP Incoterms, which is delivered duty paid, generally ownership does not pass to the buyer until the goods reach their door, which means you're making the sale in whatever country the customer's in, France, for example, and so would be subject to French VAT, and you would be the importer in that country, which is what we'd like to try and avoid if possible, because that's when things start getting complicated. So the easiest way, if you can achieve it with your buyer, and generally if you're selling to EU businesses, you should be able to, is for you to export the goods from the UK. You fill out the export documentation and the buyer imports the goods into their country. Now, I have had some where the buyer has refused to do that on the basis that Brexit is our fault, we can get on and sort it for them. They don't want to have to do any extra paperwork. But on the whole, most EU businesses are happy to accept that. So if that is what you're doing, if you're exporting the goods from the UK, you zero rate the sale here, but you must have evidence that those goods have left the UK. So if you ever got a VAT visit and HMRC wanted to check why you had exported, why you had zero rated the goods, you've got to have something commercial to show they've gone. So that could be the invoice from the freight company showing they shipped it, the bill of lading, the registration number of the truck that the goods went on, the flight number of the flight that they were flown on, and so something like that. You've got to be able to prove the goods have left the UK for that zero rating. And what HMRC suggests sometimes, if you might not have that information up front, perhaps because the buyer has organised part of the journey, charge them VAT initially and only give them the VAT back once they've provided you with that evidence, because you must have evidence on file for that zero rating. And then the buyer will deal with the import VAT and the duty where they receive the goods in the same way as we do when goods come into the UK, as we mentioned earlier. So that's probably, well, I don't want to tempt fate here, but I think selling to the EU businesses is probably the most straightforward bit of everything we're going to cover. So we move on to importing goods valued under £135. So again, this is an exact reproduction of my slide from 2020 because nothing's changed on this. So these rules came in the UK from the 1st of January. And you can see there, I've put a quote from William Shatner, which is why I left this slide in, because I don't often get to quote William Shatner in VAT presentations, so it always tickles me. And he basically was a bit cheesed off here, you can see in that, because our government wanted to force non-UK sellers to collect VAT on orders being shipped to the UK. He's looked at the costs, £1,000 a year, so tough cheddar, I'm not selling anything to the UK. So what I'm going to stop sharing that screen, and I'm going to share this screen, which hopefully you'll be able to see. I went on his website this morning and checked, and it says, "We ship to the United Kingdom. Welcome. You can easily shop in your local currency, enjoy our great international shipping rates, and pay import taxes and duties and taxes at checkout for a guaranteed price." So somewhere along the line, he's obviously had a change of heart and realised that he probably should sell to the UK. So, what have I done? Am I back on the slides now? Can you see the slides on the screen again? Excellent. So he's obviously had a change of heart, but the issue was for importing goods under £135, and that's the consignment value, not per item. The place of supply becomes the place of sale, which means that UK VAT has to be accounted for by the seller or the marketplace facilitating that sale. So if you think back to before Brexit, if you bought some goods from the EU, they would just have been sent direct to you. You wouldn't have had to think about any VAT or any charges. Now that's different, and the VAT is due, but it's got to be dealt with by the seller. So for goods under £135, you should not be getting a bill from, I know there's a lot of scams at the moment with Royal Mail, people getting messages from Royal Mail saying you have to pay import VAT and duty before goods will be released to you. But that shouldn't be the case on lower value goods, because the seller should have dealt with that. And the issue that William Shatner was referring to there is that means the overseas seller has to register for VAT in the UK, because they've got to charge UK VAT and declare the VAT on the sales. You can get around it if it's an online marketplace, because they'll deal with it themselves. If you're buying stuff through Amazon or eBay or Etsy, that they will deal with the VAT, so that the seller doesn't actually need to register in the UK. That change had actually been planned for a long time, not just for the UK, but for the whole of Europe. The difference was the EU decided to delay it because of COVID. So it actually didn't come in until the 1st of July, whereas the UK didn't delay it and it came in from the 1st of January. So that was the issue there, with the slight timing difference. So looking at it the other way, for sales to EU consumers, this came into effect from the 1st of July 2021. And I would say this probably accounts for half of the Brexit related questions I've been trying to get to grips with. It's a massive issue. So as with the sales to the UK, from the 1st of July, if you're selling goods to a consumer in the EU and they're worth less than 150 euros, VAT is due in the country that you're selling to. So if you are selling to someone in France, you need to charge them French VAT, Germany, German VAT, Italy, Italian VAT, and so on and so on. So some of you may have heard of the distance selling regulations before, which were where you could sell without charging German VAT to Germany or French VAT to France until you hit the specific threshold for that country. That's now gone. There is a €10,000 threshold for this, but it doesn't actually apply to GB. So if you sell one thing worth £10 to France, you should be registered for VAT in France. And that's why this is a massive issue. There is an import one-stop shop, IOSS, which you may have heard the phrase thrown around. And that's a simplification whereby instead of having to register in France, Germany, Italy, Holland, in every single country, you have one overall IOSS registration and you collect the VAT for each country, but you include it on one VAT return, make one payment, and then the authorities of that country pay it to the tax authorities in each of the other countries. There is a problem with the import one-stop shop in that originally we thought we would be able to register in the UK as a non-established trader in the same way as we have been able to for digitally supplied services. But in order to register direct, you have to have a mutual assistance agreement with the EU. And some countries think that the trade and cooperation agreement we have with the EU does amount to a mutual assistance agreement. And some countries think it doesn't. And at the moment, the only country which has been allowed to register direct is Norway. And it's been concluded that GB cannot register direct to use that import one-stop shop. So we can use it, but you've got to pay for somebody in the EU to do it for you. So if we move on, we've got 6 potential options here for if you're selling goods to consumers in the EU. Option 1, you pay for a fiscal representative in the EU to register you for the import one-stop shop. You charge all your customers VAT based on whatever the country they're in. On the plus side, it's a smooth procedure for the customers. They don't know anything. They buy the goods from you as normal, and you're dealing with all the VAT and declaring the VAT and the duty in the background. It's a very smooth process for the customers. On the downside, the minimum costs I've found so far are £2,000 a year for doing that, because if someone in the EU is acting as your fiscal representative, they're taking on responsibility for your VAT liability. So they are usually only prepared to do that if they are indemnified in some way. And by the time you've factored in the actual time costs of them doing the work, putting the return together, and the costs of the responsibility of acting on your behalf, the costs rack up. So not worth it if you sell 5 t-shirts a year to Germany. But if you're selling all the time, it is worth it. I think I read something which suggested if you may have sales transactions to the EU, more than 3,000 packages a year going to the EU, it's probably worth it financially. Otherwise not. Option 2, which sounds like it will be amazing, is Post Office PDDP. So this is a new scheme which Royal Mail have come up with called Posted Delivered Duty Paid. So it's almost going to work like you pay the post office for postage, but that will be a bigger figure because it will include the VAT and the duty that's due in the country you're posting to. So it's more efficient because you're only going to be paying per transaction. On the downside, it's not yet available to all countries in the EU, so it only works if you sell to specific countries, and you've got to have compatible software, although I suppose the software issue is probably an issue with any of these options, but the customer needs to know the VAT and the duty when they order the goods. You can't just charge them for the goods and then say, oh, and by the way, here's a separate bill for the VAT and duty. So you do need to get your software in line for that. Option 3 is another option which Royal Mail have come up with. It's an add-on. Taxamo is the one Royal Mail use, but I'm sure other add-ons are available. You pay per transaction. It's quite similar to the PDDP version. You pay per transaction. So I think the example on the Royal Mail site, it's £2 per transaction admin fee, plus the VAT and the duties, and they deal with it all. But again, you need to have the compatible software in order to make it work, so the customer knows what they're getting at the end of the day. That was recommended if you sell fewer than 3,000 things to EU consumers each year. So I've split the options over 2 pages. Those 3, I think, are the main 3 options which will be the best solution to most businesses. The 3 on the next page are the less attractive options. So option 4, you do nothing. You just post the goods to the EU as you always have been. The customer is going to get a message from their postal company saying you owe us some VAT and some duty, or you're not getting the goods. And feedback I've had so far is when that happens, the customer says, on your bike, I'm not paying anything else. Send the goods back. The goods get sent back to the UK. You're losing the goodwill of the customers, and you're losing the sale, and you've got the additional costs of the postage, even though the goods haven't gone anywhere. So I can't really see that as a viable solution. Option 5, sell by platform. If you sell via Amazon or eBay or somebody like that, it's treated slightly differently. So you are making a sale from the UK to a business, and then the platform uses their import one-stop shop registration to make the sale. And the way I've seen it work for eBay is that eBay will provide you with the IOSS number to include on the export documentation when the goods go out. Again, it might be a viable option for a lot of businesses, but obviously I don't want to plug making very, very rich people or even richer. Might not be an option for you. And if you've already spent a fortune on a website that does loads of things, do you really want to direct sales away from that website and onto a platform where there'll be a little advert at the bottom popping up selling somebody else's goods for less than yours? And option 6, which unfortunately is the one quite a lot of businesses I've talked to are going to, stop selling to consumers in the EU. If the only way you can sell to them is to pay £2,000 a year to a EU fiscal representative, and you only make £500 worth of sales to the EU each year, why would you bother? And surely that is completely contrary to everything we were told would be a benefit of Brexit. You know, it's just, it makes me quite sad. I'm trying not to be political, but it does make me quite sad, the number of businesses who I've heard who've said either it's too complicated or it's too expensive and it's just not viable. So they're just going to stop selling to the EU, unfortunately. And I think that was the last of the slides that I was going to share. So what I will do now is work out how to stop sharing my screen. And if I stop the recording, or maybe Jason needs to stop the recording, I'm not sure. And then hopefully you can all feel more comfortable turning on your cameras and having a chat and letting me know if there's any of those particular issues that I've mentioned that you've been having, or if there's any other issues you've come across that you'd like us to talk through.